roughly $20 billion in negotiated equity value. I'm sure many of you are already familiar with some of the deals Gus has worked on, but it's worth noting a few. Most recently, Gus advised Aspire Global, which is the intended combination of NavSite Holdings. He also led the sale of Origin Materials to Ardius Acquisition, ChargePoint's sale to Switchback Energy, and the Canoe, which is now symbol Go EV, sale to Hennessy Capital 4. Additionally, some pending combinations include ArcLight Clean Transition Corp's combination with Proterra. And lastly, the pending acquisition of EVgo by Climate Change Crisis Real Impact Acquisition Corp. Furthermore, for the transactions that have already closed, the median percentage of SPAC shareholders that redeemed for cash is below 1%, which is an impressive number. In addition, Gus has worked on and overseen transactions with an excess of $150 billion in value across pipes, corporate separations, and other mergers and acquisitions transactions. So clearly, Gus has vast experience with SPACs, and in particular, the D-SPAC transaction. But more importantly, his transactions have all been very successful.
Christy, thank you for the very warm intro. Not warranted, but I appreciate it, and it's very nice to be here with all of you, both on Zoom and on Clubhouse. Great opportunity provided by SPAC Insiders. So thank you. Looking forward to the discussion tonight. As the title implies, a lot changes every single day, and it certainly has changed even more so as we compare to prior years. So with that, let's kick it off.
All right, let's get into it. So, as the title of this talk implies, we're going to talk a little bit about the past, present, and the future, but naturally we're going to start with the past. So first thing I kind of wanted to ask you, Gus, was it's a pretty general question, but how are SPAC combinations today different from SPAC combinations of the past? And by the past, I mean the recent past, meaning like 2018, 2019, before, the current SPAC boom.
Yeah, look, it's a great question. I think there's a lot that's changed. If I were to pick one thing to highlight, it would be what the transaction is a surrogate for, right? If you go back, the SPAC transaction in many ways was a surrogate for M&A, right? It combines elements of M&A, it combines elements of an IPO, but it was much more on the M&A side previously. And by that, I mean, people would sell out a majority of their business, 70, 80, 100% would be taken out. And so the name of the game was, how do I convince somebody else to own this company, right? They need to step into these shoes, and the seller is in many respects going to be taking a minority interest or a zero interest in some cases. And what's changed from there is a surrogate for an IPO is what most people try to achieve today. Really a AAA IPO, which means I'm going to sell a minority of the business. That means I'm going to sell 10, 20, 30% of the business, not a majority. And I'm going to be a majority stakeholder in these projections that I, as a seller, am conveying to the street, and that I, as a SPAC sponsor, and standing behind. So I think the big change here is, how do people structure the transaction? In an IPO, you're looking to get long-term shareholders. There's a lot of focus on long-only large cap mutual funds as shareholders. There's a lot of focus on having the right shareholder base, less focus on getting out completely up front, which previously I think implied things like structuring pipe transactions to have promote and things of that nature.
Well, you bring up a good point. I mean, how is it different now than it was in the past with negotiating a SPAC combination back then, and even closing a SPAC combination?
Yeah, look, I think the most challenging aspect previously was awareness and getting people to even come to the table. As a SPAC banker, prior to late 2019, it was always an uphill battle to convince a seller that this isn't a four-letter word, that it is not an option of last resort, that there's real benefit to it. I think the SPAC product, even at that point, was still in its nascency. And by the way, if you were a SPAC practitioner, 17, 18, and 19, by all measures, were boom years, right? When you were in those years, that was 3 to 4 times the typical activity. But even in that environment, it paled in comparison, of course, and we now know that looking back, to where this market could go. So the most challenging aspect for me back then was getting people to even start the conversation. Because when you start the conversation, you actually learn that there's a lot of benefit to this transaction. But back then, the big hurdle was just bringing people to the table. And then once you did negotiate the transaction, how do you close the transaction? In a surrogacy for M&A, how do I get people to step into the shoes of a company that has put projections out, but whose owners won't necessarily be majority owners? Mm-hmm. How do I get pipe capital to come in a market when share prices above $12 per share were not the norm? Right? It was rare to see stocks rise above that level between announcement and closing. And there it was about, well, I maybe need to pay some of my pipe investors with promote. Maybe I need to give them some of my warrants and incentivize them to come in. So that was the challenge in closing the SPAC combo. That, of course, has changed in the recent market.
Mm-hmm. And, I suppose you could argue that in the past year, it sort of looked easy to do SPAC combinations, just given the massive success of most of these deals. But how challenging was it? How challenging was the deal flow back in 2018, 2019 compared to today?
Look, the deal flow itself, of course, was lower, right? So the challenge would be from a quantity perspective. At the same time, the number of participants was also lower. So there was some level of equilibrium between companies exploring SPACs and SPACs wanting to explore mergers with private companies. The deal flow back then, though, didn't feel to us like it was low. In fact, we were asking ourselves, well, if it's at 3 to 4 times the level that it used to be, is it sustainable, right? Will we find ourselves 2 years from now looking back and saying the market got ahead of itself, there's too many SPACs too soon, not enough people could find a home? And I think if things had stayed the way they were, we'd absolutely be in that position today. Mm-hmm. But what happened between then and now is the quality of sponsors increased, the quality of the companies exploring the SPAC process increased. Surprise, surprise, better quality companies perform better in the aftermarket. And so that attracts other sponsors and other companies, and it just snowballed to where people would now have a conversation about it. So there's a lot of private companies. I don't think anybody on this call will be surprised by that are exploring the SPAC option. It's rarely a day that you turn on CNBC, the Journal, or Reddit and don't hear something about SPAC. So there's a lot of momentum, even though it was challenging from a quantum perspective in the past relative to today. There's always been, and there still is, we'll get to the present and the future in just a bit, but there still is this sense of equilibrium, interestingly enough, between supply and demand.
Mm-hmm. Yeah. Well, actually, maybe that now is a good time to sort of pivot to the present, just because there's a lot more to talk about. But the M&A environment, and it's interesting too, because even though it's the present, August we were just discussing feels like 3 years ago, even though it was only 6 months. But how different was the M&A environment in August versus maybe now? In regards to the SPAC offs we've been hearing about.
Yeah, look, August started to feel like a fever pitch, right? June, July, August, the market was starting to get a tailwind, and people were very much exploring the SPAC product. It was still an environment where you still had a lot of conversations with companies about whether it's appropriate, whether it's an option of last resort. But the deal flow back then was firing on all cylinders, and in many respects, the challenge was getting sellers comfortable that they were getting an appropriate valuation. One of the things that caused a lot of difficult conversations between myself and the companies that we would represent is looking at other SPACs that were trading in the market, right, within their sector. And they would point to it and say, well, look at this company, it's trading at $20, $30 per share. I'd like to price right around there. Right? That's what I think my company is worth. And that comes from a natural desire to comp yourself, right? To compare yourself to public companies. The challenge was that these companies had risen so far, so fast, that it wasn't necessarily being driven by the same investors they were looking for in a pipe. Mm-hmm. Right? So you might have had different shareholders driving the stock price higher after announcement, but then many of these sellers were also looking for pipe capital from institutional investors that probably were more grounded in the lower valuation. So I think activity back then was nowhere near where it was, let's call it in January, February, but it was at a very big multiple to where it was even in 2019. So, the SPAC market continues to evolve. Shortly after that August time period, we hit a slowdown, then we sped up again. Now it looks like we're slowing down again. The market's trading off in a multiple week period. But I think, I think there's durability to it. That August time period was probably the first time that, in my mind, SPACs reached true mainstream status, that people started to talk about it as an alternative of first resort for the first time.
Right. And I know we chatted previously, but maybe you can kind of talk to the audience a little bit about how you think, sometimes these up and down cycles, they're healthy.
I do. It's a great point, because one of the worst things that could happen is if a market simply goes up, and doesn't take a breather, because inevitably there's going to be a very big and painful decline, right? When things get, quote, ahead of themselves. So October, November, we had many clients that were in the middle of a pipe process. We had many companies that were announcing then, and things were tough, right? You would make an announcement, your stock price wouldn't move. You'd approach pipe investors and they'd say, I'm looking for a 30% concession on valuation. And at the time, I think what we heard from the buy side, from institutional investors, was our risk departments are having us take a closer look. Our SPAC book is overextended. I'm overextended on a specific sector. I've got a lot of pipe capital outstanding. At the time, 11 billion of pipe capital was tied up, which matched the entire 2018 issuance, right? So at the time, it was just starting to get away of itself, or way ahead of itself. And with the decline and subsequent stabilization and increase, that's a sign of a great market, right? Every single market out there, right? Equity market, IPOs, follow-ons. If somebody says to you, markets are trading off, it's not a great time, that doesn't mean that the market's closed. It means that that's a healthy pause, resetting, regrouping. And I think that's what we saw in October, November. I think that's what we're seeing here today. And that's what you want to see for durability. I think if we come out of this, it's going to very much solidify the fact that this market is here to stay. It goes through all the normal cycles that every capital market goes through. So time will tell, but we're looking for we're looking for that to continue.
Well, speaking of prices, right, and the ups and downs, I want to talk a little bit about pipes. Specifically, how challenging has it been to sort of get the right valuation for pipe investors, particularly when you have, share prices trading like crazy versus now, which is the opposite problem, right? You have things trading near cash and trust value. How difficult is it getting pipe investors into announced deals right now?
Yeah, and look, my departure from the market and from B of A occurred March 1st. So from that perspective, I'm not in the middle of the market as it stands right now. And of course, we officially are in a quiet period. But there's a lot of an analog to the October, November timeframe when the market similarly traded off. Pipe investors were on strike, for lack of a better word. I suspect there's much of the same going on today, but with the benefit of hindsight that things can get bad and they can get better. So my guess is, we saw a couple of pipes price well north of $10 per share before the recent slowdown. My guess is that doesn't happen on a mainstream basis anytime soon, that people are reevaluating the fact that, okay, well, pipe investors are locked up. for 2.5 to 3 months while the company goes through its SEC process. And there's illiquidity, and they need to take that into account when deciding what valuation to come in at, certainly at what price to buy. So my guess is it's more challenging. Back in October, what we heard a lot was, I like the business. Very rare that we heard people say, I'm not investing at all under any circumstance. It would typically be, I like the business, but the price needs to come down. Valuation needs to be haircut, 10%, 20%, 30% in some cases. So wouldn't be surprised if that's happening right now.
Got it. Let's talk a little bit about the warrants, mostly because a lot has been made about, the warrants for teams. You've got, 1/8 warrants, no warrants, one quarter warrants. How important are warrants to target companies right now? Is it something meaningful to them when they're negotiating the deal? Do certain SPACs look more attractive based on their warrant structure? Like, how are they kind of viewing that?
It's such a great question, and as many different SPACs and private companies as there are out there, you will find an example of whatever opinion you've got in your head. We had companies that viewed warrants as the one and only thing that they needed to focus on. That warrants were the main source of dilution. Other people would say, it's not the warrants, it's the founder shares. That's what you really need to focus on. In our conversations with sellers, we would always advise them to focus in on the things that mattered the most first. So if you look at what a founder owns of a pro forma company, it tends to be 75 basis points to 5% of the shares outstanding of the combined company. So if you were to put the screws to somebody and have them eliminate 50% of their founder shares, which would be extremely high, for your client and you as a private company, you've achieved maybe 100 basis points of incremental ownership. You compare that to things like seller earnouts. That's where when the stock price rises, the seller themselves receive additional shares. Those tend to be 6, 7, 8, 10% of shares outstanding of the company. So on a relative basis, you're talking 8 times, 9 times, 10 times as potent. So we would always guide towards focus on the sponsors who, of course, understand your business, of course, where there's a fit, but the economics that really matter are the base valuation somebody's willing to approach the market with you, the presence of a seller earnout. The founder economics were, right, I think there's a lot of money left on the table with people that negotiated very narrowly on founder economics, but left out things like a seller earnout, right? That you would have been able to negotiate had you been able to find a SPAC sponsor that you didn't put the screws to. So while I think it's important, the warrants of today are a fraction of what they were yesterday, right? When you're talking about a quarter, a fifth, going from a quarter to a sixth or a fifth to an eighth, we're talking very small differences at this point. That's not really what's going to matter. And when people run the math and look at where is it that I should care about, I think they're mostly going to care about seller earnouts and the base valuation that a SPAC is willing to approach pipe investors with.
Got it. Yeah, that makes sense. Let's talk a little bit about shareholder base, mostly because the shareholder base has undergone significant changes in 2020 and 2021. But if there are a significant number of ARBs in the shareholder base, how does a target company view that when they're entering into negotiations? Like, does it scare them? Maybe you could just talk a little bit more about that in the shareholder base.
Yeah, one of the most common questions I received as advisor was, what's the SPAC's shareholder base like? And what's the likelihood that their shareholders are going to redeem? How do I ensure that they've got the right shareholder base? And, the interesting part is the data is very clear and says you want to see 100% or more of the shares of the SPAC turn over between announcement and closing. And when you have that, redemptions are effectively zero. And when you don't have that, redemptions are much higher. And so That doesn't mean necessarily that every single shareholder has sold their share, because one shareholder could sell the same share several times. But what it does mean is that there's a significant amount of churn between announcement and closing. And the reason that's good is because when there's churn, it tends to mean that there's liquidity in the stock. And it oftentimes occurs when the stock price is well above the cash and trust level. So whether it was ARBs, whether it was long-only investors, whether it was retail in the stock, you wanted to see movement, because if there are buyers of the stock after the M&A deal is announced, and they're buying at $11, $12, $18 per share, they're making a very active and conscious decision to buy at a value that is well above the amount that they could get back by redeeming their share for cash. And so that's why, surprise, surprise, you don't see a lot of redemptions when you see a lot of trading activity. So what we would always say is, don't necessarily focus on who their investors are today. It could have very well changed relative to who they placed it with in the IPO. They don't have control over that. It's a public company. What you should focus on is, how do I make sure that this company trades incredibly well, that the right shareholder base comes in as part of the PIPE process, that the right shareholder base comes in between announcement and closing, and also post-closing. And when people have focused on that, you have universally seen thus far the product working. And by working, I mean redemptions are low, trading liquidity is good post-closing, people have access to follow-on offerings and research coverage.
Yeah, I agree. So last question sort of about the present. Obviously, we have a tremendous amount of SPACs out searching for combinations, and we have another 200 plus that want to IPO shortly. Does deal flow meet that number? Like, meaning if by the end of the year we have priced 1,200 SPAC IPOs in 2021, is there enough deal flow, enough companies that want to go public with a SPAC to sort of meet that demand?
Yeah, I mean, one of the most surprising things for people to hear is when I mentioned that it's a buyer's market out there, and buyer being the SPAC and seller being the private companies. And B of A decided to create a head of SPAC M&A position, which concentrated all of the flow into one group. And so all of that activity I had visibility into. And as recently as February and March, we had very high quality assets. And we would reach out to SPAC sponsors and ask, would love to introduce you to this company. It's got all of these characteristics that you should feel very excited about. And the feedback we would get is, I'd love to, but I'm tied up. I'd love to, but we're out of bandwidth. We're evaluating 3 or 4 other opportunities at the same time. Please come back to me in 4 to 6 weeks. Maybe something will have changed. And that happened repeatedly. So as many SPACs as there are, and there are more than at any time in history, and it is always surprising to see how much activity there is, because 2020 was more than 2019, and Q1 now is more than 2020, and so on and so forth. But what's also kept pace is the private companies that are very interested in exploring a SPAC combination. Even when I left here on March 1st, I was still having conversations with venture capital partners and private equity firms about the SPAC product, about the fact that it's no longer an alternative of last resort, but rather the alternative of first resort. And so the supply is continuing to evolve, right? And there's a lot of infrastructure at advisory shops that is focused on building out the SPAC product, the SPAC process, et cetera. So even though there's a lot of SPACs, and there's many more than when I was having these types of conversations, even 3 weeks ago or even 3 months ago, you have a lot of private companies looking to merge with the SPAC. I think the challenge is going to be, how do you parse through that, right? A lot of the feedback or a lot of the questions that I would get from SPACs when I was in an advisor position really highlighted the fact that there's a lot of lack of understanding on what works for SPACs, what's going to work for public markets. You may have had a lot of experience investing on a private basis, very different than investing here for SPACs. So that's where having the right experience, the right team, I think will stand apart. I think that's what people are going to look for. Companies are going to look for the teams that can very quickly identify, yes, you're going to be successful as part of a SPAC combination. I'd love to partner with you. That's the challenge, not so much the total supply in aggregate, but rather how do you filter that total supply that's plentiful, as far as I could tell, and make sure that you've actually partnered with somebody that is going to be successful in the public markets.
Right. So I guess what you're saying is we're kind of looking at it the wrong way, thinking there are too many SPACs, but it's really it's actually more challenging for the company because they don't know how to filter that down to the teams that may be meaningful or useful to them.
There's some element of that. I think it's also a challenge for SPAC teams themselves, right? That in a world where one of the things that we've seen as a bottleneck is on the advisor side, whether it's auditors, lawyers, investment bankers. There's just a lot of flow, right? And people are short-staffed, and it's hard to get to everything. Eventually, you'll get your call returned. Eventually, you'll get the advice, but you kind of have to wait your turn in queue if you're a SPAC sponsor, right? I would oftentimes hear, is this target a viable target? I just spoke to them. They seemed like a good combination, and they weren't. For a lot of different reasons, they were not the right target, and it wasn't going to go anywhere. But that's time that's been wasted evaluating an opportunity that was never going to work, right? So I think the challenge is twofold. On the one hand, yes, private companies need to decide who to partner with. Although I'll tell you, private companies do a pretty good job at filtering through who the right fit is going to be. At the end of the day, it's a human-to-human interaction, and who's going to sit on my board, who's going to make my life productive, who's going to challenge me in the right ways, not the wrong ways. So that part, I think, sorts itself out pretty easily, and advisors are there to help. Finding the right targets as a SPAC team, I think, is I think is a challenge for many.
Yeah. All right. Well, let's focus on the future. What do you think? I mean, I know it's a little bit challenging for you right now to talk about, but what do you think is going to be the major considerations for teams going forward in this SPAC environment, other than what you just mentioned? Is there anything else that teams need to be mindful of going forward?
Yeah, look, I think like any capital market that goes through cycles, there's going to be sectors that go through cycles that fall in and out of favor. So I think if you're a SPAC focused on a specific sector, there's probably going to be times that you need to bide your time, spend a little bit more time looking for the right target, etc. I think, like just to repeat it, parsing through the right opportunities is certainly going to be a challenge. And then I think for a lot of folks that have not yet had, in many ways, having experience is good, but having experience when things get bad is even better. Mm-hmm. And a lot of folks finding themselves in the position that we do today, I think that's going to be a challenge for a lot of people. Where do I find the right pipe capital? How do I restructure the deal? How do I reposition a business? All of that is challenging, especially for anybody who hasn't gone through the gauntlet before. So really nothing different than anybody else that has gone through a capital market cycle, but it's certainly going to be applicable to the SPAC market.
Right. This is a giveaway question, but how many SPAC IPOs you think we'll do by the end of the year, and how many combinations, meaning closed deals in 2021?
I mean, look, as far as capital raised, and we're on track to blow 2020 out of the water as it stands today. Now there's a little bit of a breather in the last few weeks, but by all intents and measures, just to give some specific stats to the listeners, at this point last year, 11 transactions had closed. There's 19 so far that have closed this year. So you're on track to almost double the activity. 66 transactions closed last year. So that would mean, close to 130 transactions. Now, my guess is we'll go through periods where it's less of a flurry of activity and others. So do we go 50% higher from where we did last year? I don't think that's out of the realm of possibility. But I think the underlying question is the durability to the market. Irrespective of where we end up this year, is it 40%, 50%, is it flat to last year? What's going to happen the year after that and the year after that? And I kind of go back to looking at markets that go through cycles are able to take a pause, analyze what's gone on, analyze all of the capital that you just allocated to the SPAC sector, to pipes, to IPOs, et cetera, as an investor, and still want to be involved in that market. And when that's the case, I think you see a lot of, you're going to see that the SPAC market's here to stay, that there's a long game here to play. We're in the very early innings. That's probably crazy for a lot of people to hear, that despite all the activity that we see today, that this is the early innings. But you know, when you see the amount of private companies that are looking to explore the SPAC alternative and that are just now getting started and building out their teams, I think this is the beginning, right? You've seen a lot of sectors that were hot for decades, whether it's LBOs in the 80s, private equity in the 90s, hedge funds in the aughts, et cetera. This is kind of that SPAC decade in many respects. And I think you're going to see a lot of transactions close this year. You're going to see a lot of SPAC IPOs this year. How many per quarter will vary, but my guess it'll be at a premium to where we ended 2020.
Got it. All right. Well, I think that's probably a good place to stop, and we can open it up for a Q&A. We're going to try and do this on both platforms, both Clubhouse and Zoom, so bear with us. But if you're on Zoom, you can hover your mouse at the bottom of the screen to activate the control panel, and you'll see a Q&A icon. You can submit questions that way. But then we can also take some questions from the audience in Clubhouse as well. I'll just give everybody a moment or two to submit anything. We did have one, Gus, from earlier. They must have submitted earlier and I didn't see it, but they asked, how does the number of SPACs searching for targets compare to the number of private companies looking to consummate a SPAC transaction? I think you kind of answered that a little bit, but if you have any additional thoughts on it.
Yeah, I mean, I think to put a number to it, I would estimate that you could see a 2 to 3-fold increase in the number of SPACs before you reached a sense of equilibrium. And that number is going to change constantly as markets go through cycles, as private companies continue to evaluate whether this is the right alternative, as venture capital firms, private equity firms continue to evaluate what this product can do for their portfolio companies. So as it stood, as of the time that we kind of last did this market check, it's at that level, right? In my estimation, and especially for the right SPAC team, still a buyer's market out there. Still a lot of private companies looking for a SPAC combination with a SPAC partner.
Eric, sorry, I'm going to talk directly through you guys, but Eric, if you could join the Clubhouse and help us out here, because I think, Gus, I think you actually have control of the questions. So,
Clubhouse.
Yeah. We do have some questions in Zoom, which we can get to first, but let's see. There's a question here. A how do you think litigation will play out? There have been more and more lawsuits coming through, and will that put a pause on some of the activity?
Look, that's a fair and very good question. There in the news has been a lot of examples of companies that are getting sued because the statements that they made weren't accurate, because the diligence wasn't sufficient. Just like many M&A transactions, so put aside SPAC, just like many M&A transactions, there's always lawsuits associated with the M&A transaction. I think the better question is how many of those have merit and will actually rise to something other than just ambulance chasing. And like any market that grows at this pace, I think that's going to happen, right? I think that for us as advisors, it was always of paramount importance to do all the diligence in the world. You know, by the time that we made contact with SPAC sponsors, we had taken these companies through the ringer, making sure they were ready to be a public company, making sure that the statements that they made were accurate, etc. Whether that happens or not, broadly speaking, is impossible to control. But you would hope that that's where the market goes, that this is not a product that's meant to short circuit the diligence process. It's really a product that's meant to enhance it. You spend a lot of time talking to investors about projections. You spend a lot of time talking to investors about disclosure. You have that extra room to do work, and people should take it. And if people do, I think litigation will be just like any other aspect of the financial markets. It'll be there, but it won't necessarily overtake. And to the extent that there's a requirement for people to pause, take more time, that's an outcome, right? I think that's a way that litigation would play out, is that things shouldn't move so quickly if it's resulting in issues. Things should maybe take a little bit longer to percolate, for people to do their work, for people to do diligence as you would any M&A transaction. So we always approach it that way. I would hope that that's how the market as a whole approaches it. And I think as it becomes more institutionalized and you have a lot more advisors coming into the mix, that's exactly where the market will go.
Got it. I have another question regarding deal valuations, and about how the question is deal valuations seem to have gone up recently. Has this been on the rise given the number of SPACs competing with each other for deals? So I guess what they're asking is the competition causing valuations to increase?
Yeah, I think this happened back in August. It happens in any hot market where sellers are looking at who's out there, who's gone through the SPAC process recently, and they say that valuation has to be my valuation. I'm a better company than that company is, in fact. So my valuation, if anything, should be higher than that. Well, one of the things that we always said to SPAC sponsors is that we would not have them compete on value, because at the end of the day, the SPAC, you oftentimes hear words or phrases like, "What's the SPAC going to pay me? How much are they offering me for my business?" Those questions imply that there's a takeout of your business happening, but it's not, right? This is a surrogate for a AAA IPO. So you're actually owning 80-90% of your business pro forma. So it's the public market that's being asked to come in and buy these securities. So just because you partner with somebody that offers you a very high valuation, that doesn't mean that that's where the market's going to trade you. That doesn't mean that you're going to be a successful public company. And what I would say to clients was, I'm probably going to be the only M&A banker in your life to advise you to take a lower value at some point in this process. And I forewarn them ahead of time, because it would come from a place of wanting them to have a viable security for the long term, having access to follow-on offerings, having access to their equity for when they wanted to merge with companies. And that advice, I think, is being absorbed and understood by a majority of participants. You will always have the seller that refuses to believe that that's the way it should be, that will view this as an M&A surrogate and will say, no, they have to pay me more. And I think if you guys went, without pointing at fingers, if you guys went and looked at the deal list, completion list on Christie's website, and looked at the transactions with high levels of redemptions, there's going to be a big chunk of those that fall into that trap. A lot of people that end up with high redemptions ended up negotiating too high of a value, and most likely driven by sellers insisting that value get higher. So is it being pushed higher? Yes. Are there conversations like the one that we just had that resonate with sellers? Also, yes. And there's, of course, going to be sellers that refuse to believe that and stick to their guns. And I think in those cases, the market can always bail you out. So if the market continues to go well, they can be proven right, quote unquote. But I think for the long term, and good practice would be to ground people and say, let's take a look at where this sector has been historically. Let's take a look at where these transactions have priced, right? Not just where they've traded to, because oftentimes there's runaway values. And I think in having that conversation, you stay a little bit more grounded in valuation, and you avoid very huge upswings followed by very big crashes, which again is conducive to a long-term market.
Okay, next question. And they're talking to you directly. They say, Gus, the system is clogged with too much supply of SPAC IPOs right now. We are seeing it with the way IPOs trade post-pricing. What will unclog it? Most likely we need to see the IPO market closed for a period of time to absorb the recent deals. Alternatively, we need to see a lot more announcements. How do we get to a more normal environment?
Yeah, look, it's a very good question, and we saw the same thing happen in October, November. Same thing, where people took a look at what was happening and they said, geez, maybe this is it. I heard see that the SPAC market's over, it was a good run. And when people get into that mindset, remember, we tend to overreact in both directions, right? We overshoot to the upside, we overshoot to the downside. My guess is that you'll see less activity. Remember, what you see in the IPO market is a lagging indicator already. People have already been locked and loaded for a long period of time. They've been going through the process and they want to get out. I think you'll start to see it go through ebbs and flows. When people see this happening to a market, they'll say, well, maybe it's a good thing I didn't try my hand. I've already heard from several would-be SPAC sponsors that said, I think I'm going to take a step back. I'm going to wait and see how this all shakes out. So the more people that do that, that's going to help on the supply side. And the more teams that you see get built out across the street, you're going to see a lot more M&A activity, right? And that's happening at large shops, small shops. It might be surprising to a lot of you folks, but the teams that are being built out, the task forces, the dedicated groups that are focused on SPACs, that's all very recent, right? And it's expanding. Even as of a few weeks ago, people are adding to this. It's getting better. So you'll see people start to clear that backlog out. But remember, M&A takes longer than the IPO process, right? It takes a while to actually negotiate the deal and do that deep diligence that I talked about. And then takes another while to go raise PIPE capital. And then it takes another while to actually close the deal and free up that capital from the pipes that people have allocated to. So yeah, this is exactly what you see. It's a very good question, whoever asked that, but this is exactly what you see in these market cycles, but I think it's a healthy part of it, and we'll see it unclog just the way it did in October, November.
I have sort of a side question for you. So what do you think about SPACs that are announcing their combinations in like 45 days from IPO?
Yeah, look, I mean, there's obviously a restriction from pre-wiring anything, so that's of course assumed it is not happening. In some cases, it could be that, and each example is going to be different, but it could be that the SPAC sponsor team had a very long relationship and knowledge of the asset that they were merging with. Right? There were many examples. This was a former founder of a business that they led for a very long time and then departed 12 months prior. It could be that they've looked at the opportunity, not in the context of a SPAC, but in the context of a private raise, and became intimately familiar with the business, knew everything there is to know from a diligence perspective. And so by that measure, there wasn't really much left to do. So it could very well be that you're seeing that. Speed, of course, is good from an IPO investor perspective, right? It's less time for you to realize gain and for you to realize profit on your investment, as long as it's being done the right way, to where people have done all the diligence that you need to do. And I would stress that it's of utmost importance to make sure that you kick the tires, verify, trust but verify, that old phrase. And as long as that's happening, I think it's okay. If it wasn't, then I think that would be disappointing.
All right. I have two interesting questions. The first one, though, says, Gus, any idea what percentage of target companies trade above NAV after the deal closure, 1 year after the deal closure? And then they write, I hear 7 out of 10 companies trade below NAV 1 year out.
Yeah, I think time period is going to matter a lot, right, with respect to how this is measured. And remember, the SPAC market completely changed from even 2019. The types of companies that were coming to market, the industries that were covered, et cetera. We tracked at my old shop a median of stock prices of all the transactions that closed starting Jan 1st of 2020, and all the transactions that had announced but not yet closed. And it's the one, since almost every single SPAC is based off of a $10 share price, it's the one time you can average or take a median of share prices and have it actually mean something. And, you know, for deals that had closed for a very long period of time in Q3, Q4, you were seeing those trade at 50, 60, 80% above negotiated value. That's on a median basis, so it's not, you know, a very high share price that's skewing the data. And for deals that had been announced and not yet closed, that was trading upwards of 30, 40, 50% higher than negotiated value. So I think it's a little too early to tell and to draw a conclusion, because the quality of the market has completely changed. The quality of the participants, of the companies, et cetera, are night and day different. So I think that stat was probably true if you looked to historical transactions. I think I would discard those altogether and say, you know, it's reset time, 2020. And in fact, even the first half of 2020 in many ways is different, but you know, you got to start somewhere. I would say going forward, time will tell where we end up. But what I could see whenever I would run the analysis is no difference between the transactions that close well, meaning with low redemptions, and an index, for example, the S&P 600, which is about the size of the average SPAC transaction. So S&P 600 is constantly replacing companies for high quality companies, right? So you have good liquidity, you have the survivors, of course, and it was no different for SPAC transactions that close with low redemptions. And I think by that measure, and intuitively it makes sense. You're not creating a CDO or a CDO squared. This isn't something that's never been done before. You're creating a public company, right? Public companies have existed for a very long time. It's just a different way to go public. SPACs replace the underwriter. You know, if you think about what an underwriter does and what a SPAC does, it just replaces it. So I think time will tell, but I would be surprised if it resulted in anything different than, you know, your general IPO population.
Got it. All right. So next question, and then we probably only have time for one more. But are there any considerable contrasts between SPACs with target companies in East Asia, Europe, and the U.S.? Meaning, what are the differences between, you know, when, well, actually, we wrote, you know, as far as deal flow, litigation, or anything that comes into play?
Yeah, I mean, what immediately comes to mind is frequency, right? If you were to act, what percentage of SPACs are focused outside the U.S.? That's probably something like 5 to 10%. You know, explicitly in their documents say that they're looking for a specific region, for example. Deal flow is probably similar to that, if not lower, because a lot of the SPACs that wanted to be focused on a specific jurisdiction end up finding their way back to the U.S. as time goes by and they can't find a target. So I think that frequency is number one. Complexity would be number two. There were many companies in Asia that we were advising going through the SPAC process, and there's a lot of nuances. There's transfer taxes. There are, you know, authorities within the local jurisdictions, the Israeli tax authority, for example, from whom you might need to get a ruling. So there's additional considerations that add to time. Right? It doesn't mean that there aren't very high quality assets, but it certainly adds to the time that it might take to structure the appropriate deal. And time, of course, is not the friend of SPAC sponsors, since they have a shot clock to complete a deal. I think that's the main difference, is frequency and time as of today. Those teams are also being built out. The SPAC product is also being very learned, and people are being educated about it every single day outside the US. I think that will continue. I think people will see more flow from outside the US, but I don't think it's going to overtake and be, a 50-50 mix anytime soon. My guess is it continues to be a minority.
I think that's probably a good place to stop. It's almost 5:30. Don't want to keep people too long, but thank you very much, Gus. This has been a really informative conversation, and I appreciate you taking the time out to join us and educate everybody.
Thank you, and thank you everybody for joining. Take care.
Have a good one, everyone.
Get out of here. Oh. Howdy. What's going on, everybody? Yeah, guys, I thought we were going to see some juicy information. I wanted to shoot some SPAC questions on that guy. But yeah, it's really interesting to see that guy. He ran a few deals for a few companies that you might know. His name is Gus Garcia, Bank of America. But yeah, guys, I'm going to roll out. I'm working on a couple videos at the moment. Some BNGO videos where I was doing a deep dive into what's going on around the world, and especially into the genomics industry and government funding and where they're allocating it, and also some deals with some of our providers. So it's pretty interesting what I'm working on at the moment with BNGO. But yeah, lovely to have you guys here, man. Thank you everybody for joining, and I'm going to be releasing some videos tonight and tomorrow, baby. So get sticky. Peace out, guys. Thank you very much, and I'll catch you in a bit. Mr. Invest a lot, over and out, baby.